Claire Toth with my colleague Fritz Schoenhut.
Good morning.
Good morning from Point View Wealth Management on what seems like the 300th day of April. Welcome to our monthly webinar. This month, we're going to be talking about the CARES Act and associated forms of relief from COVID-19.
And before we get started, I just want to remind everyone that there is a poll that we would like you to take a quick look at, a survey, and you can access that on the side of your screen.
There's also a chat function to ask questions. We'll get to those at the end of the presentation. What we're covering today is top level highlights, mostly as they apply to individuals, because there's a lot of small business relief out there. There's relief for nonprofits. There's a bunch of different things, but we're talking about most of the individuals. And I'm going to lead off with taxes and actually tax deadlines. We know already that in large part, the April 15th deadlines for both filing taxes and paying taxes have been pushed back to July 15th. That's both federal and for almost every state. Virginia and Mississippi are outliers there. Virginia is due June 1st. They actually pushed that back. Mississippi, I'm not sure. The trick here to be aware of is if you pay estimated taxes, the traditional due date for the second quarter estimated tax payments is June 15th, not July 15th. Last week, the IRS finally pushed that due date from June 15th to July 15th. That's a fairly recent change. States are all over the place. Some states automatically link their filing and payment deadlines to the federal date. So for instance, California and Ohio, you already know that your second quarter estimates are not due until July 15th. Other states have to take affirmative action to change those dates. So New Jersey, New York, Massachusetts, North Carolina. As of Tuesday, at least, your second quarter estimated tax payments are still due on June 15th. But watch this box because states are changing all the time. And we expect many states to push this deadline back as well. We just don't want anyone caught by it.
So now the subsidy payments, these are the $1,200 stimulus checks, and many have been receiving these already. I believe some are still waiting to receive them, but they should be in hand now or relatively soon. Now, just as a reminder, this is not in advance of a tax refund, but rather just a payment directly to taxpayers. And it's based on your 2019 or your 2018 tax filing. And as a reminder, the 2019, as Claire mentioned, is due July 15th. They're not federally taxable, so there's no taxes due, and they appear to be tax-free in all 50 states, though some states haven't released exactly what their plans are, but it appears that they are tax-free in the states as well. There's an additional payment of $500 for each dependent child with certain thresholds. And so, you may be eligible for more than just the $1,200 payments directly. And again, not everyone is eligible for these payments. They do phase out at certain income limits. So you may need to check your recent tax files or your tax accountant regarding this. IRA relief for retirees. So what the CARES Act did for 2020, there's no required minimum distribution. This has been a somewhat pleasant surprise for a lot of taxpayers, our clients specifically, and it applies to inherited IRAs as well. And additionally, if 2019 was the year you were to receive your first RMD or your required minimum distribution, you had until April 1st of 2020 to take that distribution. But with this being passed, that was no longer required to be taken, pushing both your 2019 and the 2020 distributions to 2021.
Well, or more specifically, just eliminating the need for them.
Precisely.
The trick about this, the delayed distribution for 2019, is that the CARES Act passed or became law on March 27th. And because that payment had to be taken otherwise no later than April 1st, very few people fell into that 4-day gap where they didn't have to take it at all. There may be some other relief.
Now we get into the issues with prior distributions. I know we've had a lot of questions regarding this. So as it is currently, there's no special relief, and the existing law still applies, which is that you are permitted one reversal during the course of the year, and that reversal has a 60-day look back. So if you were receiving your MRD on a monthly basis, you could potentially claw back 2 months worth of distributions. There is no way to repay taxes withheld if you had any withholding on those distributions. And there's also no way to repay any direct charitable contributions as well. This is an area that is still up for debate, and we may see subsequent changes regarding the previous distributions in 2020, but as of right now, the current law regarding the distributions and the reversal of payments still applies.
If you are not retired, or even some folks who are, there's additional relief regarding retirement plans, both 401ks and IRAs. Typically, if you withdraw from any of these plans before you're age 59 and a half, not only is it fully taxable, but there's also a 10% penalty. The CARES Act has done away with certainly with the penalty and has changed some of the tax rules. Now, within certain parameters, you can withdraw up to $100,000 from your 401k, similar retirement plan, or IRA, no penalty. And the tax on this, on the withdrawal, can be paid ratably over 3 years. Plus, if you repay the money back within that 3 years, there's no tax at all. It's essentially an interest-free loan to yourself. The language of the legislation doesn't have any coordination between your ratable tax payments and the repayment of the distribution. So, for example, you take $100,000 this year and you pay it all back in one lump sum in 3 years. You're still required to pay taxes ratably over the next couple of years, and it's not clear, other than filing for a refund, how you'd get that back. So that's another area where we're going to be looking for additional guidance. Not everybody gets to pull money out of the retirement plans willy-nilly. There are some fairly specific requirements. One is that the account owner, the spouse, or the dependent has to be diagnosed with COVID-19 or another version, SARS version, using a CDC-approved test. There's a bunch of test kits out of that are floating around. It's got to be a CDC test. And this requirement applies certainly to people who are currently in the workforce, as well as to retirees. Beyond that, another qualification is if you've got lost job, lost wages, you're in quarantine, so you've got a financial reverse. if you can't work because you've got child care issues, or if you're a business owner and your business is shut down or contracted, those are all valid reasons for pulling up to $100,000 out of the retirement plan. Note that elder care is not one of the reasons. And again, that's something where I hope we're going to be getting some additional relief. Further, the Secretary of the Treasury, which means the IRS, can come up with some other criteria. But clearly, this is designed for folks who are suffering real financial distress. Beyond this sort of tax-free, is it a loan, isn't it a loan, you get to choose. That if you want to take an actual loan from a retirement plan, and this is a retirement plan only, not an IRA, the traditional limit had been $50,000 or half of your vested balance. That's been doubled for this year. The upside of taking a loan rather than a distribution, you don't have the same strict criteria, and you don't have to pay tax ratably. Instead, you do have to pay interest. And that would be fairly low at this stage of the game. The other thing to know, that if you're repaying one of these distributions, that doesn't affect your ability to make additional annual contributions. So if you have the wherewithal, you can continue to do that as well. Fritz?
Yes, so there's been some updates to the charitable deduction allotment for those taking the standard deduction in 2020. So previously, if you were not taking your itemized deductions, but rather taking the standard deduction, you couldn't deduct any charitable contributions. Now, what they've allowed for in 2020 through the CARES Act is that you can take the standard deduction and an additional $300 in charitable donations to be deducted from your adjusted gross income. Now, this must be a cash gift. It cannot be appreciated assets, and it must be to operating charities, not to donor advised funds or any other organizations that are supporting charities. They must be direct cash payments to charities themselves.
And if you do itemized gifts, the charitable deduction has also been expanded here as well. Prior to the CARES Act, you could make gifts of appreciated securities up to 30% of your adjusted gross income, also referred to as AGI. You could, beyond the 30%, you could make up to 60% of your adjusted gross income in cash gifts layered on top of the charitable gifts, so that the total gifts to charity equals 60% of your adjusted gross income. And of that 60%, up to half could be of appreciated securities. So the CARES Act has increased the 60% to 100%. You can give all of your adjusted gross income to charity, and of that 100%, 30% can be gifts of appreciated securities. Again, these have to be gifts to operating charities. Congressional intent is that this money gets spent, goes to charities that are providing relief, and actually goes directly to them this year. This does allow some tax planning opportunities. I'm thinking specifically, I've got a client I'm working with who is asset rich, but has very low taxable income. So this client's in a position to give away 100% of their income this year, and at the same time can perhaps create additional income by making Roth conversions out of the traditional IRA that will generate additional income and will allow for additional deductible gifts to charity, so that this client can make significant gifts without paying any tax at all on a Roth conversion, and then down the road reduce the need for required minimum distributions from that IRA because it's a smaller account. That gets a little complicated, but there are some planning opportunities around this. Student loan provisions. We've got a holiday on student loan payments and interest accruals from March 13th through September 30th. And this applies to all federal student loans, and it's automatic. There's no requirement that the borrower be suffering any sort of financial setback. So for those with federal student loans and the ability to do so, continuing to make payments on those loans means you're paying, everything you're paying goes to principal. And for those with multiple student loans, you can direct those payments to the loan with the highest interest rate. And this is a great way effectively to accelerate paying off your loans altogether. This provision only applies to federal loans. So if you have private loans, or if you had federal loans that you had refinanced into a private loan, unfortunately, this provision doesn't apply. Still, it's worth, if you've got private loans, it's worth taking a look at the interest rate on those, and seeing if you're eligible again to refinance those loans to a lower rate, because there's some very low rates out there.
So the refundable tax credits for the self-employed. So with the coronavirus outbreak and companies, shutting down, a lot of people may find themselves, out of work, or kind of their way of life has definitely changed dramatically. And so what the CARES Act has done is put in some rules and tax credits available to those that are self-employed that may be impacted by COVID-19. So first of which is the tax credits for sick leave. And so what this allows is for the refundable tax credits of up to $500 per day for 10 days of sick leave. And again, what refundable means that you get this tax credit even if it is beyond the tax liability you owe for the year. You will receive that as part of a tax refund. Additionally, what they've done is create a $200 per day for up to 50 days for qualified family leave. So with a lot of children home from school, taking classes online or whatever it may be, this allows for some income to be made up, or cash to be added, for those days that maybe you may not be able to work and you need to stay home and care for your children. So the $200 per day for 50 days is another benefit of the CARES Act.
And again, these are just a few highlights, and I know we've zipped through them very quickly. There's a lot of detail within them and a lot of meat on some of these bones. So we expect a fair amount of questions. And we've got a few of them. I'll lead off. We got one question about whether you can still make a charitable gift out of your IRA if you are 70 and older, and under what circumstances that might make sense. And yes, you can still make charitable gifts out of an IRA if you'd otherwise qualify. And I have clients who are still doing this. Right in 2020, the standard deduction for a married couple, if you're both 65 or older, is $27,400. So there are plenty of folks out there who, whatever their level of charitable giving, they're not going to surpass that standard deduction. They otherwise wouldn't get it. They won't get a tax deduction for that charitable gift anyway, other than the $300. So in that sense, in that situation, it makes a lot of sense to continue making your charitable gifts from your IRA. essentially you're leaving your taxable assets intact. They are less expensive for you to use for daily living expenses, for any emergency that comes up. You're also, by reducing your IRA, you are reducing your required minimum distribution in future years. And at the end of the day, by having more taxable assets, fewer assets within an IRA, you're giving your eventual heirs a better income tax outcome. And that's a long conversation I'm happy to have with anybody. Fritz, we've got another question about RMD withdrawals.
Yeah, so here's a question. Has the IRS indicated that all RMD withdrawals for 2020 can be reversed? So as mentioned earlier in the presentation, the current guidelines are for the 60-day look back and a one-time reversal of distributions for 2020. So going forward, you do not need to make any further distributions from your IRA, but anything beyond the 60-day look back would not be reversible. The IRS has not indicated that they will be kind of changing this or allowing all distributions to be reversed. That remains to be seen. Who knows if there's a 2.0, but as of right now, the current distribution reversal rules apply.
And I did want to clarify on one point. If you have taken tax withholding from your distributions, you're not going to get that withholding back from your federal or state tax bureau. If you want, you do have the ability to, if to the extent you can reverse a prior distribution, you can reach into your pocket and put the tax money back in as well. At the end of the year, you'll get a 1099 from the account showing that the taxes have been withheld, and it will apply against your 2020 taxes. So you can reverse the tax portion of the distribution as well, but you're not going to be able to get it from the tax man. You have to reach into your own pocket to do that. And we've also got a question about qualified persons getting the $1,200 payment. Fritz, do you want to take a first stab at that?
I believe that you are still qualified to receive the federal stimulus payment, though there is potentially an additional form, a Social Security form, to complete.
Okay. And then back on the reversals from IRAs, the 60-day reversal rule, there's a question about whether that applies to all accounts or one account. You are allowed one reversal per year, end of sentence, across all of your IRAs. There's no difference if the RMDs you've taken so far are from one account or from multiple IRAs. And wow, we have apparently overwhelmed everybody. We can take a quick look at our poll and see what kind of poll results we've got. We asked if you've received your coronavirus relief payment, and half of you have said no, you haven't received a relief payment because you're not eligible to receive one. Those are tied to income, and I think they cap out at 125,000. Is that correct, Fritz?
For joint?
For joint, yeah.
For joint, it's 198,000 is where, yeah. So it's a phase out from 150,000 to 198,000 is where anything over that you will not be receiving the check.
Okay. 43% of you are still waiting on your payments. I'm sorry to hear that. I know the IRS website has a track my payment feature that apparently does nothing but crash. 6% of you have received your stimulus payment. Good for you. Congratulations. And if you have questions we haven't answered, if you want to reach out to any of us, we'd be thrilled to continue discussing this with you. Thank you for taking the time, and on to better days ahead.
Thank you.
Thank you.